At ITW, one of my mentors, Jim Farrell, told me, Joe, just get the facts, let the facts tell you what to do. So the question becomes, why should I listen to Jim Farrell? So I always share this at some point in my remarks. When people say, well, this 80-20 ITW thing, did it really have legs? So I give them this stat. During the 25 years I was at ITW, I joined them, we were 200 million. I retired from them when we were 19 billion. So we grew a lot during that time. At one point, I ran about $1 billion of it. And during that 25-year period, we had a 19% compound annual shareholder return. So when I tell it to people, most people, a group like this will understand that. Many people don't. So then I ask the question, how many of you have stocks or mutual funds? They all raise their hand. And then I ask, how many of you would like to have your stocks return 19% this year? And then I say, how many of you would like to have your stocks return 19% every year for the next 25 years, irrespective of all these disruptions? And they all raise their hand, and I say, that's what we did. And so when we talk about growth as opportunity, when we talk about this methodology, using things like this, listen to Jim Farrell. He was right. I was smart enough to do so. Go back and do key ratio. See what it tells you. Your data is dying to tell you a story. Let it speak. So what is 80-20? I've got 15 minutes to get through this, and I think I can pull that off. This is the one chart I chose to kind of describe it. Everybody understands the left two. You're all like this. You all get it, right? So we've got a pyramid on the left, which is your customers. You've got a small group of customers at the top that are very large, and a large group of customers on the bottom that are not very large, right? You've got a revenue pyramid, which is inverted. Those few customers at the top generate lots and lots of revenue. Those lots of little customers at the bottom don't generate a lot of revenue. And we all understand that. That's the 80-20 rule in action, right? The critical few, the more trivial many, right? But the key to the Nichols pyramids, we call it the Nichols pyramids because John Nichols was a guy who brought 80-20 to ITW in the first place, one of my mentors. Talk about a lucky guy, that's me. He flipped the last pyramid on its head. Because if you listen to GAAP, if you listen to financial accounting, what they say is, how do we apply overhead costs? We apply overhead costs to our P&L by revenue, right? So the bigger you are, the more overhead you must absorb. And what Nichols said is that's not true. What Nichols said is we do financial accounting, of course, but managerial accounting is more important, which means that a little customer thinks they're as big as a big customer. They drive the same amount of resource allocation. When the phone rings at your company, doesn't it ring just the same, whether it's a big customer or a small customer? It does. Big customer, one salesperson, two R&D people, they just don't drive the resources. That was Nichols' hypothesis, which turned out to be theory, that big customers, there aren't many, they generate lots of revenue, and they don't require much overhead, which means their key ratio is really high, which means their profitability is really high. And if you actually were to draw a line through the middle of this chart, what you'd find is that above that chart, you make a lot of money. How much money? Roughly 150 to 200% of your profits. So I'll say that again. North of that line, halfway through it, you make 150 to 200% of your profits. What that means, of course, is that below that line, you lose money. That's a big qualifier to think about. People always say, I make more money on my big customers than I do on my little ones. And they're right. But what they still believe deep down in their souls is that they make something on those little ones, and the answer is you don't. The answer is that you don't. The answer is that the little ones need to be treated much differently if they're going to be profitable at all because of this Nichols pyramids idea. So the Nichols pyramids really is the 80-20 basis that says we have to treat them very differently. And the opportunity is to overserve those critical few at the top, which we don't do today. There's that line I was talking about. And this is reflected by quartile analysis. This is something you guys can do. Take it back, give it to your finance people. They can whip this out in an hour. I'll put these numbers up and then I'll explain what they are. What you do is you go back and you stack rank your customers or your products. It'll work out the same either way. Stack rank them from the biggest to the smallest by revenue. You can do it by gross margin, material margin, but it's all the same. Revenue's easier. Biggest customer all the way down to the smallest for any year period, fiscal or calendar, doesn't matter. Stack rank them, biggest or smallest, and then divide them by 4. So if you have 1,000 customers, 250, 250, 250, 250. If you've got 500, 125 a piece. In this example, it's 200, so we go 50 a piece. Just divide them by 4. Once you're done doing that, now figure out what % of my revenue comes from each one of those quartiles. And the answer almost invariably will be, as you see here, 89731. It's unbelievable to me still, after 30 years of doing this, 40 years of doing this, it's 89731. I remember the first time I did this, I couldn't believe it. It's 89731, it's 89731, which led me to a question, which I still ask myself today. Do you mean to tell me that half of my customers are 96% of my revenue and the other half is 4% of my revenue? Is that possible? Not only is it possible, it's almost always true. So, first step, go back and see if it's true. Don't take my word for it. Go back and see if it's true. But if it's true, now ask yourself the ramifications of that, right? Because the ramifications that are in the next column. What percent of my overhead, what percent of my effort am I putting into each one of those quartiles? And what we have found over the years, it's now theory, is that it's roughly 25, 25, 25, 25. You mean to tell me I spend as much on the little as I do on the big? Yeah, you do. Why? No job too big or too small. Have it your way. We treat every customer like it's the only customer we have. That's what people do. The phone rings the same. It's just driven into us from birth that we treat everybody with equality. But as it's said in the one thing, equality is a lie. Equality is a lie. We can't treat them equally because some are more important than others. Believe me, I treat my wife much differently than I treat our CEO, David Philippi. He doesn't matter to me. My wife runs the household, right? So the equality is a lie. So if this is the case, what jumps out at you? Challenges, opportunity, you bet. Because granted, if we take a look at 4% of the revenue and we realize we spend 50% of our overhead on that, that's a losing bet. We can be more profitable by having less overhead, which is true. But what's the great opportunity there? The great opportunity there is look at that 89% up top, serving it with only 25%. We should and can and must do more. So a very quick way to look at this is, what if I sacrifice 1% of my business and I took that 25% and reallocated up top? Could I find markets that I could really focus on with dedicated attention? It's the only thing they work on, and would that generate greater growth? And that's what we found has happened. When people look at 80-20, they think of it as a cost thing. It's not. It's a growth thing. ITW, in the years I was there, we were top 50 every year in patents granted. How did that happen? It happened because we understood this fundamentally, that we needed to overserve our critical few at the chosen expense of the rest, who needed to be treated much differently. And that opportunity is there for you. So when you look at being at the forefront of the electrification movement, right, where are you going to get the resources during the Great Resignation to fund those critical things, to put the time into those critical things? Here's an opportunity for you to do that. So again, read the one thing, for sure. Do your key ratio, for sure. Do your quartile analysis, for sure, and see if you turn out this way. And if you then turn out that way, now ask yourself, what do I do about that? Again, basically, fairly easy what to do. There's some nuance to it that you probably want to know about, but if you listen to the data, it's a really good place to start. So you can see, as I put up here, I always call them whales and minnows. One of my favorite lines is, there's two ways to grow a company. You can go catch a large fish, or you can get a bucket of minnows and feed them. Better to catch a large fish, right? So that's what this is all about. And Maggie always does a really good job of that. So I'll give you one case study, and then I'll share one little personal 80-20 thing, and then I'll stand aside. So we could tell you numerous stories about how ITW did this very well, and how Danaher did this to a lesser degree, but still well, and how many of the clientele that I've had the opportunity to work with over the last however many years have done this really well. But I'll just share one with you, and that's IDEX. If you don't know, IDEX are a multi-billion-dollar company out of Lake Forest, Illinois. Run initially, when I started working with them, by a guy named Andy Silvernail. Andy has since moved on, and Eric Ashleman is there today. And this is their story. They started 80-20 back in 2010, right? So these numbers are dated, but that's so I can share them with you. So they started in 2010, and this is what happened to them during that 8-year period where they really made 80-20 foundational to what they did, where they followed these rules I was sharing with you this morning. Their sales went up 67%. So when I say it's a growth thing, it's a growth thing, right? We spend time on this, not that. We do this, not that. We focus here, not there. And the result is greater growth. The result then is greater opportunity, right? Leveraging. irrespective of disruption. Disruption eventually doesn't matter, and you could lock that into your head. Disruption doesn't matter. If you focus on their critical few and understand your data, disruption doesn't matter. Their op margin increased 670 basis points. Their earnings per share were up 272%. Cash flow return on investment up 640 basis points. And their total shareholder return grew over 450%. And if you asked Andy and you asked Eric, what's responsible for this? They would simply say, without question, without batting an eye, it's 80-20. And you can see what they've done here. They changed their little insignia, right? Great teams, customer obsession, embrace 80-20. Simple things done well win for you, right? So that's 80-20 in a nutshell.